letters have to be seen in continuation. So he's been talking about sensible investing for a long time, and people who have been keen Berkshire Hathaway watchers or Warren Buffett watchers would find most of the points a repetition of things he has said in the past, but they reinforce a lot of his core beliefs. So first point at the very beginning that he emphasized is that investors should look at the actual operating earnings and the way a owner would look at the earnings rather than reported numbers which are influenced by various factors. So he urged investors to ignore one-off items and short-term fluctuations on account of mark-to-market profits and realized capital gains and things like that. So that was a very interesting thing that he mentioned. The other point that he highlighted was that whenever a company earns a profit, and if the company has good investment opportunities, the company only pays out part of the profit as dividend. The remaining money the company reinvests in its business, and which becomes a very sizable factor in terms of long-term growth of the shareholder wealth. So that was an interesting point that he made. Then these days there is a lot of fashion especially in the startup community or in some tech-related companies, that people tend to focus on non-profit metrics. So people talk about EBITDA or earnings before writing off some costs and things like that. So he urged people to stick to the traditional way of looking at investments rather than being carried away by fads and fancies and ignoring some costs which are actually real costs. We have seen a few spectacular blow-ups in the last year where people were just following stories and not actually looking at fundamentals, and then that came to a bad end. So he urged people to look at the proper earnings after deducting all relevant costs rather than look at metrics like EBITDA. One very, very interesting thing that he mentioned, and people were keenly waiting for this observation in the letter, was that he mentioned that given the extremely low levels of interest rates the world over, equity shares are expected to do far better than bonds. So there has been a lot of talk about the bull run, especially in the US, continuing for a long time, and the question as to are we headed for a bear market or are we headed for a severe crash in the valuations and things like that. So he mentioned clearly that I do not know what will happen in the next 6 months, 1 year, so prices can go up or prices can fall, but over the longer term, given where interest rates are, stocks would do much better. So he gave a caveat that if interest rates were to rise significantly, then obviously the equation changes. But based on the current environment, stocks are expected to do better than bonds. Then some takeaways were more specific to Berkshire Hathaway. So probably for the first time we'll see Mr. Ajit Jain and Greg Abel on the stage with Mr. Buffett and Mr. Munger. So he's mentioned in the letter that they would have more visibility at the AGM. So I'm assuming that would mean that they would be answering some shareholder questions. So that is one big change, given that both Buffett and Munger are of advanced age. So that would be one big change in the AGM. The other factor that he highlighted is effectively the downside for Berkshire Hathaway is very, very limited, given that they are keen to buy back shares, and they have said that anyone having more than $20 million worth Berkshire Hathaway shares to sell should call up and seek to sell them to the company. So effectively, of course, they will not stick to one price. They'll keep on lowering the price if there was a heavy selling. But effectively, the downside becomes limited when people know that Berkshire is ready to buy back the shares. So these were the main highlights as I see it. They have mentioned that valuations have been stretched for complete acquisitions, and sometimes the listed equity offers better opportunities in terms of valuations. So although they do not get to acquire the whole company, but they get a good entry price. So nothing significant has come their way at an attractive enough price, and that's why they have not been doing acquisitions. This has been true across markets, whether in the US or in India. So while the law provides for independent directors, effectively the people who get to serve on the board as independent directors, one way or the other know the either the promoter group or the CEO, and they are not really fiercely independent, or they really will not create difficult situations for the CEOs. They will be more or less docile. That's why he made the statement that effectively independent directors are not really independent in that sense, and they are more submissive rather than very aggressive in terms of taking positions.